Hey, and welcome to the Man versus Bot Show. I'm your host, the crypto coach, Blockchain Wayne. Today we're joined by Kory Hoang. Kory is the CEO of Stably, and Kory's going to tell us a little bit about trading basics and why we're here today and what is Man versus Bot. So, Kory, thanks for joining today.
Hey, thank you, Wayne, for having me on the show and organizing the show together with me. So, Man versus Bot, what is the show all about? Well, before we start, maybe I can introduce a little bit about myself. My name is Kory Hoang. I'm the CEO of Stably. The website is stably.io. Stably is a Seattle-based fintech and stablecoin slash asset tokenization company. We work with major financial institution partners as well as uh, precious metal dealers, securities dealers, various real estate people, as well as folks in the commodity industry. We work with them to tokenize various type of asset classes and bring them onto the market as cryptographic tokens. So part of my background also includes some algorithmic trading, quantitative trading. Before Stably, I used to work as a data analyst at PitchBook, and I didn't do any trading there per se, but it was something that I did on the side, like all the time. While I was data crunching for PitchBook, I was also building Python and trading algorithms that trade various instruments from stocks to bonds to derivatives and even crypto. And that's pretty much how I got my started. I've consulted for various hedge funds, traditional hedge funds, commodity trading advisors to cryptocurrency hedge funds on how to build, a systematic trend following trading system, how to capture, market anomalies and price inefficiency and things like that. So yeah, I guess I'm just a humble student of the market. I know a little bit here and there. Don't know everything, but whatever that I do know, I'm happy to share with everybody. And that's pretty much the purpose of the show. We want to, teach people about quantitative trading, about being a smart investor, about systemic trading, how to make good buying selling decision, not based on emotion, but based on rules and system that based on some sort of logic or follow some sort of scientific method, right? Quote unquote scientific. So algorithmic trading itself is just or quant trading in itself is just a very deep topic that I think we'll have to take several episodes to cover. In this particular episode, I think we'll just cover just a quick introduction and overview of what we plan to do for our future episodes, and I will teach everyone a little something about moving averages, how to trade with moving averages, since everybody know what moving averages is. And I think that will serve as a good segue into future episodes that will talk about more about quantitative trading and things like that. A lot of which would involve using indicators like moving averages. So man versus bot. The name itself implies that we are trying to beat the machine, right? So throughout my couple past few years of actively monitoring and trading cryptocurrency and stocks and various asset classes, I've kept collection of number of trading strategy and system that I've been monitoring for years and years now. That are pretty decent. They've been working for for as long as I've been keeping track of them. Of course, some of them have decay, quote unquote decay, ever since, and they don't work anymore. But a few of them have been working performing very well consistently for past several years. So I thought, why don't we take one of these strategies that I discovered a while back, in particular, a strategy for cryptocurrency like Bitcoin or Ethereum, because a lot of people nowadays loves trading crypto, right? But for the show, we'll cover other types of instruments too, like stocks and ETFs, not just crypto. But for the man versus bot show, I think we will take one of the trading algorithms for Bitcoin and Ethereum that I had from a few years back. It's been doing really well. and we can discuss more about the details in future episodes. But essentially, we will let the audience of the show try to beat the algorithm. So the algorithm will always tell us what it's going to do. We know exactly how it works. We know exactly what it's going to buy and sell, and when it's going to buy and sell. So, with that information, the audience, of course, have the option to either listen to it or not listen to it, right? And to make things extra exciting, we're going to provide you, Wayne, with a $10,000 account with Binance, so that you can trade the account based on the response from the audience of the show. So let's say the algorithm says that we should buy Bitcoin today at 5 p.m. PST, for example. The audience will, before that signal happens, the audience of the show the day before will probably have heads up from us or some sort of notification from us saying that, hey, this is what the algorithm is gonna do. Do you want me to follow what it says or do the opposite? Like, right, if it says buy, then we sell. If it says sell, then we buy, right? So basically either listen to it or don't listen to it.
Right.
And then we'll see, what the how the crowd performs versus the machine. And that's basically that's basically the essence of the name man versus bot, right? And the purpose here really is, personally for me, it'd be a really interesting experiment to see, how crowd psychology and crowd decision making can influence trading performance, especially when there is already an established trading system that the audience can refer to already. Yep. So yeah, that's pretty much a little bit of overview about the show. Do you have any question or comments, Wayne? About
Yeah. So yeah, comment. When you first mentioned this to me, a lot of things go into my head, right? I'm thinking like you, okay, do we follow the bot or not? When you first mentioned the idea of the show, it's just intrigued me ever since, because there's a lot of things with the algorithm. It takes out all emotion, right? It's just a set, fixed strategy. But when you throw in human control, it's not just, yeah, emotions can sometimes cause us harm when we're trading if we let our emotions get involved. Yep. But it also, with the bot, you're taking out intuition, you're taking out the ability to look at any kind of fundamentals. So I'm really intrigued to see how this is going to play out, and see if our audience, along with us, if we can beat the trading bot algorithm.
Yeah, for sure. I think I mean, first of all, not a lot of people out there are engaged in algorithmic trading. So I think this will be something that will be quite interesting, at least for the beginners or people who are uninitiated to this game. And we want to make it as simple and as basic as possible, so everybody will be able to kind of pick up what we're saying, what we're talking about. So yeah, we're gonna try to make this as simple and straightforward as possible, and hopefully we'll gain a lot of followers that are gonna find this kind of stuff interesting, and more and more people learning about quant trading and investing. That's great. That's what I love to hear. So yeah, I guess shall we continue with giving a quick presentation on simple moving averages to just kind of give the audience a little bit of taste of what quantitative or investing and trading is all about?
Yeah, absolutely.
Okay, sure. I will share my screen with you. Let me know if you see my screen, okay? All right, do you see my screen?
Yep, you're up.
All right, I'm gonna expand the screen. Let me know when you see it expanded.
All good.
Cool. So here's a presentation I made about simple trading strategies using moving averages. And if you want a free link to this presentation, you can click on this or type in this bit.ly link here. And I will show this link again toward the end of the show so everyone can write it down one more time. Without further ado, let us begin. So really quick before we proceed, just a quick disclaimer. Information analysis in this presentation is provided for informational purposes only, so purely informational and educational, right? Nothing in here should be considered as investment advice. So I'm not recommending anyone to buy or sell anything. This is just purely for educational purposes. Too long didn't read? Please do your own research, okay? All right, let us begin. So a little bit about me, like I mentioned earlier, I'm Kory, I'm the CEO of Stably. And previously I was a data analyst at PitchBook, where I picked up the ABCs of venture capital fundraising, which eventually led me to fundraise for Stably and start this company back in 2018. On the side, I've always been an active algorithmic trader, and I advise, as I've said, many hedge funds on various topics, ranging from quant trading to momentum and mean reversion strategies to derivatives and crypto. And since 2018, I've been leading Stably through 3 different venture funding rounds. We secure close to $3 million in funding, and we work with a lot of major financial institutions so far and partner as well, with teams of 15 or actually close to 20 members globally now. So yeah, I also used to work at Bank of America. I used to intern at Merrill Lynch. I'm a member of this really great meetup group in Seattle called Northwest Trader and Technical Analysis and Technical Analyst. So if you're in the 206 area, feel free to reach out to me and come join our group. Nowadays with COVID, we don't have as many meetups anymore, but we do online meetups now. So yeah, love to see people join and participate in our community. So let's have a quick overview about trading strategies. You don't need complicated strategy to make money in the market. In fact, the simplest strategies are often the ones that will generate the best performance in the long run. And usually most traders are either a momentum or a mean reversion trader in one form or another, and whether they know it or not. And so in this presentation, we shall explore some super simple rule-based trading strategies for exchange-traded products that represent various asset classes, including stocks, real estate, bonds, commodities, volatilities, and cryptocurrencies. And if you don't know what exchange-traded products is, exchange-traded products, exchange-traded funds, ETFs for short, they are similar to mutual funds, but they're tradable on exchanges, and oftentimes they represent a broad index of various stocks or commodities or various type of asset classes, and so they serve as a good proxy for an asset class. So there's like gold ETF, oil ETF, stock ETF, bond ETF, real estate ETF. So during this presentation, we're going to discuss trading these ETF using moving averages. Okay. So let's have a quick momentum and mean reversion 101. So behavioral finance asserts that market price often diverges from fair value because of various common cognitive biases among buyers or sellers. This results in non-random price anomalies, right? Now, the efficient market hypothesis says that the market is mostly efficient. However, based on my own experience and a lot of other market participants and traders and investors, we can feel that for sure that the market is not efficient. And in fact, we can actually prove it with data. And generally speaking, there are usually 3 ways that prices in the market behave according to the conditions out there. The first behavior is momentum, or the momentum anomaly, where there is a lack of market consensus on an asset's fair value or intrinsic value. Therefore, it's very difficult for the price to stay constant or fixed at any particular level. In the case of Bitcoin, for example, it's very hard for anyone to determine what Bitcoin is intrinsically worth, right? I mean, there's formula out there. There's like models that would provide valuations and prediction for what Bitcoin should be worth. But point Point is nowadays, you can't really, you don't really know for sure. It's very difficult. It's not as easy as stocks. Stocks is, you have a company, they have cash flow, revenue, expenses, profitabilities, etc. All these fundamentals that you can analyze, and you can determine how much a stock is worth. Whereas Bitcoin, there are some data points, but not enough compared to a stock for people to make good enough educational guesses on what the price should be. So that's why you see a lot Bitcoin and a lot of cryptocurrency prices. They tend to be very volatile. They have a lot of momentum. The second type of price anomaly is mean reversion. Mean reversion happens when there is the opposite of momentum, right? There's very strong market consensus on an asset's fair value or intrinsic value. Let's take an example, the case of a stablecoin, right? A stablecoin is supposed to be worth $1. For example, the case of USDC, US dollar coin by Circle. Every single USDC is supposed to be worth $1, and the market knows it's worth $1. They can redeem it for $1, and they can issue it for $1. So that's why nobody's dumb enough to buy it for more than $1 or sell it for less than $1. However, sometimes in the market there's going to be inefficiencies, like someone's going to have an urge to like buy or sell a large amount of USDC very quickly, and that will and they're willing to take some premium or discount as a result of that. So that would cause the price to deviate from what the intrinsic value should be. And whenever that happens, the market knows, hey, the intrinsic value is $1. The price is 99 cents. Now, if I buy it for 99 cents, I'm making, a penny profit. I'm making 1% profit, essentially, right? So when market participant does that, guess what? The price, it jumps back from 99 cents up to $1. Vice versa, if a price goes above $1, then market participant knows, hey, this stable coin, I can print it for $1 from the issuer, and I can resell it in the market for $1.01. And then they make a 1 penny profit. And in doing so, they push the price back down to $1. So, and that's what caused a mean reversion effect that you see in a lot of stable coin. The price just kind of fluctuate between like 99 cents, $1.01, or $1, more or less around that range. So that's what mean reversion is. Now, when you have neither too much momentum nor too much mean reversion in price behavior, what you get is random walk. This is what I call an efficient market, where you cannot guess exactly what it's going to do, what the price is going to do. You don't know whether or not it's going to continue with momentum, or if it's going to mean revert back to the average level. So I guess an analogy for this is you can think about going to a casino. I guess this is not a really perfect example because casino are definitely rigged or stack against the player. But let's say you walk to a roulette table and you look at the colors, red or black, right? You bet on either red or black, and you look at the board and you saw that for the previous bets in the past, let's say 20 bets, you notice a pattern where it goes red, 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 black, red, 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 black, red, 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 black, right? So that's the pattern that you saw. Now, there's a lot of reasons why there's that pattern. Was there. It could be completely random, which it probably was. But there could also be something maybe is wrong with the machine. Maybe it's rigged. Maybe the dealer or whoever is leaning on this machine a certain way that's making it do a certain, act a certain way. Who knows, right? So you don't know that. And so you can say that, perhaps there is an anomaly here with this, with the pattern of this roulette table. And, if you want to, be a trader and take a calculated risk and bet on that pattern, then, that's your choice as a trader. You can do that. Of course, if you walk to a roulette table and all you see is, very random pattern, like red, black, black, red, red, black, black, red, red, black, black, red, and it's much more harder for you to predict what the next color should be. Obviously, you would be less inclined to bet on that table, right? You would take less of a calculated risk there. So that's basically the same here with markets. You want to be able to find assets that have price anomalies that is caused by market inefficiencies. Whatever that market inefficiency is, we'll never be able to know fully, but at least we know that it's causing the price of the asset to dance a certain way. And once we figure out how that asset stands, we can dance along with it. And so, assets that has momentum anomaly, you have to use momentum trading technique to trade them. Assets that have mean reversion anomaly, you have to use a mean reversion technique to trade them. You can't use momentum technique. That will mess up the logic essentially, and that won't be good. And usually momentum and mean reversion trading logics, they're opposite to each other. So momentum trading is you buy high and sell higher, or you short low and cover lower, right? Where mean reversion trading is buy low and sell high, or short high and cover low. They're literally the opposite of each other. Whereas momentum trading is buying to strength, selling to weakness. Mean reversion is buying to weakness and selling it to strength. Okay, and that's pretty much the basics of the 101 of momentum and mean reversion. Do you have any question or comments, Wayne, before we proceed?
No, I mean, it's really good stuff. I think most people don't realize this. So this is very educational when you look at any market to understand that. And I'm sure, once you go in deeper and show some graphics, people are really I think the light bulb is going to come on for a lot of people.
Absolutely. Not a lot of people actually realize, that there are momentum and mean reversion anomalies out there. A lot of time people just, enter into the market trading whatever they want to trade. They don't analyze how that particular assets or instrument behaves. And, they might end up trading a momentum asset with a mean reversion technique, or they might end up trading a random walk asset, which is, if you're trading something that is random walk, chances are you're not going to be able to make money off of it, because if it's random, you can't guess it. You can't game it essentially. So you have to find something that gives you a certain edge. And once you figure out what that edge is, you have to use the correct trading technique in order to harvest that edge. If you use the wrong technique, then you won't be able to harvest that edge. Actually, you will suffer losses as well. So let's talk a little bit more about how to detect momentum and mean reversion. I'm not going to dive too deep into the math here and bore everybody to death, but there's two topics I want to bring up. One is the Hurst exponent, and here's a Wikipedia link that people can check out what the Hurst exponent is. It's basically a mathematical formula to derive a value, h, the Hurst exponent. So h range from 0 to 1, okay? And when h is closer to 1, it signifies that the underlying price or time series has more trend persistence or momentum behavior. For example, on the picture on the left side, you can see that there are 3 panels. On the top, there's h equals 0.9, and you see a really smooth line that is not rugged, not very, not very volatile at all. So that there is something that has very high Hurst exponent rating, which means that it has a lot of momentum or trend persistency. Contrast with at the bottom panel where you have h equals 0.1, you see that the time series there is very rugged. It's very jagged, right? It zigzags back up and down very often. And, essentially it mean reverts a lot. It reverts back to the average level very consistently throughout, the time frame that we're looking at. So the formula for Hurst gives it a h value of 0.1, which obviously makes sense. Now, if you look at in the middle panel, h equals 0.5. That right there is when you have neither too much trend persistency nor too much mean reversion. When you have neither too much of, either momentum or mean reversion, you have something that's considered random walk. Random walk meaning, it's very hard for you to predict what it's gonna do next, because there's no bias toward a certain edge. It doesn't bias toward more mean reversion periods, nor does it bias more toward momentum periods. it just have like equal amount of both, and because it has about equal amount of both, it's very hard to predict. Does that make sense?
Yep.
Okay. And so incorporating the Hertz exponent into what we call rescale range analysis on the right-hand side. Rescale range analysis is a technique where you use the Hertz exponent and you analyze assets on various different time scales in order to find out what the behavior of the asset is. Is it mean reverting or is it momentum, right? And once you figure out, obviously, what the behavior of that asset is, then you can figure out the correct trading logic in order to apply to it and trade it profitably. And again, I don't want to bore everybody to death with all the details, but if you want to learn more about rescale range analysis, click on that link there, and it'll take you to Investopedia to read more about it. Okay, so let's move on to the next slide. Now, one thing you have to keep in mind about momentum and mean reversion anomalies is they don't last forever. Nothing does. Market anomalies, they come and they go. Market anomaly exists because they're inefficiency. Once a market participant come and harvest, exploit the inefficiency to extract profit from it, the inefficiency goes away. And once it goes away, the behavior and the price of the underlying assets, it changes. So case in point is the S&P 500. The S&P 500 is the stock index of the 500 largest large cap U.S. stocks. And so it's basically a broad index that represent the U.S. economy to most people. And so we have this picture here that gives you a couple of lines. There's a blue line that represents the S&P 500 index from the year 1950 to 2015. Okay, and this assumes that you invested $1 million into the S&P 500 in 1950 and hold it all the way until today. Okay, so from 1950 to 2000, you would have made a 7,735% gain, and from 2000 until today, until 2015, you would have made another 59% gain. Okay, now if you were to trade the S&P 500 index instead of actually holding it, hodling it, then this is where you start seeing some interesting results. If you trade the S&P 500 with a momentum technique, where it's defined there in the picture at the bottom, it says daily momentum. If the previous day was higher than 0% in price change, then go long the S&P 500. Otherwise, short the S&P 500. So that's a momentum trading technique, right? So if there's positive price momentum, you want to buy it. If there's negative price momentum, you want to short it. That's as simple as it gets. And using that technique from 1950 to 2000, your $1 million would have appreciated by over 17 million% using that technique. However, for some reason, starting in the year 2000, that technique stopped working. And in fact, had you followed that technique from 2000 to 2015, you will have lost 95% of your capital starting from 2000. Interestingly enough, if you contrast the momentum technique with the mean reversion technique, which, logically speaking, is just the opposite of momentum, where if the previous day was negative, was below 0% in price change, meaning the previous day was negative, then you want to buy, you want to go long the S&P 500. And if the previous day was more, it was more than 0%, meaning the previous day was positive in change, then you want to go short the S&P 500. Using that strategy from 1950 until 2000 would have lost you all your money. You would have lost over 99% of your money. However, for whatever reason, since 2000, that technique started working. In fact, it would have generated you over 900% in gain from 2000 to 2015. Coincidentally, the same time when the momentum technique started to lose its its vibe, its effectiveness. So this right here is not just particular to or unique to stocks. This is commonly found in many other asset classes as well, from commodities like gold, precious metal, to oils and natural gas. It also presents itself in cryptocurrencies, and you know, some things in the markets, I guess, it's just eternal. There's going to be inefficiency, and there's going to be traders who want to go in and extract profit from it, and we'll see the same thing repeat over and over for many, 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 many years, well into the future, with many more asset classes, not just stocks and crypto. In the future, we have like, oh, I don't know, asteroid trading or like planet trading, maybe like 10,000 years from now, whatever. I'm pretty sure that these same anomalies will show up in the prices of those asset classes. So if you want to have some more additional resources to learn about what I've just what I've just discussed, there's some links here. Again, if you click on the link to this presentation, you can view all of these links and check it out yourself. Okay, so moving on, let's talk about moving averages, because that's the that's the core topic of our discussion today. So what's a moving average? In statistics, a simple moving average is a calculation to analyze data points by creating a series of averages of different subsets of the full data set. In layman term, it means it takes the average of the price. So I have a chart right here, right? You can see that the price go up and down a lot throughout the time period here. And there we have a blue line, which is the 20-period exponential moving average. That's the exponential moving average of that line. Basically, it's just the average, right? It smooths out the movement of the price, and it gives you an average level to analyze to see, on average, where the price has been historically. And a lot of people would use the moving average as an indicator for trading. And so the common conception and or perception in the market is, with a moving average, you want to buy when prices is above moving average and sell when the price is below the moving average. Well, that's only half true, right? That's only true for assets that have momentum anomaly, because what you just described there is a momentum technique, when you buy when price is above and sell when price is below the moving average. Momentum technique is essentially buying into strength and selling into weakness, right? That works well when the underlying asset has momentum behaviors. It does not work well when the underlying asset has mean reversion behavior. In fact, if you use momentum technique on something that is mean reverting, it will kill you. It will actually generate a lot of losses, because what's going to end up happening is you're going to buy, you're going to think you'll be able to buy low and sell high, but what's going to happen is you're going to buy high and sell low. That's usually what ends up happening. On the other hand, with mean reversion, moving averages could be used by buying when the price is below the moving average and selling when the price is above the moving average. Again, just the exact opposite. So here I have two pictures comparing the two technique with the candlestick charts and moving average. So you can see that the chart on the left, when you buy, if you buy when the price is above the moving average, most of the time it works out well. However, the one on the right, if you buy when the price is above and sell when it's below, you're going to have a bad time. However, you do the opposite, then it starts looking a lot better, right? So just a quick example visually on how these trading techniques with moving averages would look like. Do you have any questions or comments, Wayne?
No, not at this time. It's I think it makes a lot of sense, and moving averages are something that it's one of the first things people need to learn, just to identify trends. So this has really been educational for me since I first talked about the show, just to see the differences in markets and how moving averages work differently and depending on the type of market you're in.
Mm-hmm. Yeah, Absolutely. It's very important to, know what market you're in and how to use the indicator to trade, especially moving averages. So, now I'm going to provide some example of trading strategies using ETF representing different various asset classes. So here I have a back test for the S&P 500 ETF. The symbol for it is called SPY. It is very large and very liquid ETF that has a lot of trading volume on major stock exchanges. So here is a long-term momentum strategy where the rules of the strategy is you would buy the ETF when price is above its 200-day moving average, and you would sell it and buy TLT, which is U.S. Treasury bond ETF. So when you're not in stocks, you move into bond. So basically, price above 200-day moving average, you're staying in stocks. Price above, below 200-day moving average, you go into bond. That's it. Very simple. I use a platform called Portfolio Visualizer in order to backtest this strategy. And I also included a 2% annual deduction to 2% 2 percentage point annual deduction to the performance in order to simulate trading fees and slippage. Now, in real life, your trading fees and slippage is going to be different based on what brokers you use and what platform you use. For simplicity's sake, I'm just taking 2% off of the total performance number. And if you click on this link I have here called Backtest URL, it will actually take you to the Portfolio Visualizer website where you would have the actual backtest here that you can view. There are many tabs where you can view the summary for it, including the description of the actual strategy, metrics, performance number, annual returns, monthly returns, drawdowns, rolling returns, even the trading signals themselves that happened in the past and the signals that's going to take place in the future. This is actually a feature for paid members of Portfolio Visualizer only. So I'm a paid member. That's why I'm able to see this. So as you can see here, this particular strategy, we can see that the price is above the moving average, and the signal, is telling us to buy the S&P 500. So that's why it's advising us to hold 100% of that ETF right now. And so generally when you analyze a backtest, there are a lot of statistics that you can look at. Here you can see initial balance and final balance. Obviously, that's the amount of money that you start with and the amount of money that you end up with throughout this whole entire backtested period of, from 2003 to 2020. CAGR or CAGR is compounded annual growth rate. So this has an annualized return of about 10.66%. And standard deviation is the annualized volatility measure. So this has annualized volatility of about 12%. And then there are other statistics that you can also take a look at. Usually what I like to look at the most is actually the equity curve chart down here. It would it would visualize the performance of the strategy versus buying and holding the underlying asset. So you can see that the blue line is the strategy where we buy the S&P 500 ETF when its price is above the 200-day moving average. And the red line is for performance if you just buy and hold the S&P 500 and you don't trade it. You can see that during the 2008 crisis, where the market crashed, the strategy did really well. It managed to avoid the crash and held its ground, and it's been growing steadily ever since. Has some underperformance recently, but did okay this year. Didn't suffer as much drawdown this year and managed to recover as well. So yeah, overall, a decent strategy that uses the 200-day moving average. I also have other strategies in this presentation that shorter term than 200-day moving average. Oh, by the way, for every single strategy, I include a picture of the actual chart and the moving average next to the rule so that people can actually look at the chart and see what it looks like when these signals happen. Here's where I showcase this short-term mean reversion strategy for the S&P 500. So this strategy, unlike a momentum strategy, you want to buy it when the price is below the moving average, below the 5-day moving average, because it's a short-term strategy. You want to buy when the price is below the moving average and sell when the price is above. And when you sell out of the S&P, you buy into bonds, you buy into government treasury. And so, this strategy would give, the equity curve for this strategy would look like that. It looks really nice. It has about 16% in annualized return with about 19% in annualized volatility. And the red line again is the buy and hold portfolio. And I don't think I will cover every single piece, every single back test I did in this presentation, but you can see that I cover, strategies ranging for everything from tech stocks to health stocks to financial stocks, real estate, investment trusts, preferred stocks, Genma bonds, which is guaranteed mortgage bonds from the government, junk bonds, high yield corporate bonds, in other words, gold. We're going to commodity now, right? So gold, silver, oil, volatility. So this is VIIX. This is derivative exchange traded note for the volatility index of the S&P 500. So again, strategy for volatility and also Bitcoin. This here is GBTC. GBTC is exchange traded trust for Bitcoin. So it's actually not Bitcoin. It's a exchange traded trust that holds Bitcoin. Basically, represent Bitcoin. And the price doesn't track Bitcoin 100%, exactly. But generally speaking, it also exhibit momentum anomalies similar to Bitcoin, which is why we're able to capture the profit from that anomaly. And yeah, so I guess that's all. So again, the audience will have the link to this presentation. They can check it out and learn more about these mean reversion and momentum trading techniques. Before I end the presentation, just a few words from our sponsors. So, Stably, my company is actually one of the sponsors of this show. So we have this awesome product called Stably Prime that we're launching soon. It's a borderless account where we allow you to store, send, and receive money from anyone, anywhere, anytime. So it doesn't matter if U.S. citizen, Chinese, Japanese, Vietnamese, Russian, whatever. As long as you pass verification and you can open the account online with us, you open this account, and it will give you essentially an alternative U.S. Banking or bank-like account that can custody both fiat currency, both U.S. dollar and cryptocurrency and stable coins. And also TradeStation. They're actually not officially all sponsor yet, but I am talking to them about becoming a sponsor for this show. TradeStation is a great algorithmic trading platform, as well as a discount stockbroker in the United States, and they also have TradeStation Global. You can trade commission-free stocks, ETF options, and futures with this award-winning platform. They've been around since the early 2000s. Personally, I use TradeStation myself, and it's a kick-ass platform. I love TradeStation. I've been using it ever since 2014, and when it comes to stock trading, I really don't use anything else besides this platform. So yeah, if you have time, check out Stably Prime and TradeStation with the link at the bottom below there. And also, if you again want to download this presentation for free, you can follow the bit.ly link that I have there. And if you have any questions or comments, feel free to email me at kory@stably.io. And that's a wrap. I think that shall
All right.
the man versus bot show for today. Next episode, we will actually cover, the ABCs of algorithmic trading, and actually dive into the bot that we are going to utilize for this show that the audience gonna try to outperform. So yeah, until next time, bye everyone.
All right, thank you, Kory. Take care, everybody, and we will see you on the next episode.